We review the most recent evidence from academic studies that strongly suggest, contrary to the original expectations of many, that increased reliance on fee-based activities tends to increase rather than decrease the volatility of banks' earnings streams. The second misunderstanding is the belief that banks earn non-interest income chiefly from non-traditional non-banking activities. We perform some calculations of our own and demonstrate that payment services, one of the most traditional of all banking services, remain the single largest source of non-interest income at most U.S. banking companies. This is the first of two articles in this issue of Economic Perspectives that examine how banks make money. The companion piece that follows describes the wide diversity of business strategies being used by commercial banking companies, some of which rely disproportionately on activities that generate non-interest income, and compares and contrasts the risk-return profiles of banking. Companies that employ those strategies. Banks earn non-interest income by producing both traditional banking services and non-traditional financial services. In fact, even before deregulation provided banks with increased opportunities to sell non-traditional fee-based services, say in the mid-1980s, non-interest income already represented about $1 out of $4 of operating income generated by commercial banks. And the dramatic increase in non-interest income at U.S. banking companies over the past 2 decades reflects not only a diversification of banks into non-traditional activities, but also a shift in the way banks earn money from their traditional banking activities. Deregulation opened the door for commercial banks to earn fee income from investment banking, merchant banking, insurance agency, securities brokerage, and other non-traditional financial services. The key deregulation was the Gramm-Leach-Bliley (GLB) Act of 1999, which created a financial holding company (FHC) framework that allowed common ownership of and formal affiliation between banking and non-banking activities. Although GLB was the big bang that eliminated most of the Glass-Steagall Act 1933 prohibitions on mixing commercial banking and other financial services, partial deregulation had occurred during the 1980s and 1990s. In the late 1980s, the Federal Reserve allowed commercial banks to set up investment banking subsidiaries with limited underwriting powers. And in the mid-1990s, the Office of the Comptroller of the Currency granted national banks the power to sell insurance from offices in small towns. The fees generated by these new, non-traditional activities are uneven across banking companies. On the one hand, investment banking has been a natural addition to the product lines of large banking companies that have large corporate clients. On the other hand, insurance agency has been a good fit for banking companies of all sizes that wish to cross-sell new financial services to their retail household clients. Banks have always earned non-interest income from their depositors, charging fees on a variety of transaction services. For example, checking and money orders, safekeeping services, for example, insured deposit accounts, safety deposit boxes, and cash management services, for example, lockbox or payroll processing. Other traditional lines of business for which banks have always earned fee income include trust services provided to a wealthy retail clientele and providing letters of credit, as opposed to immediate dispersal of loan funds, to corporate clients. In recent years, advances in information, communications, and financial technologies have allowed banks to produce many of their traditional services more efficiently. These efficiencies not only reduced per-unit costs, enhanced service quality, and increased customer convenience, but also represented a source of increased fee income for banks. Advances in credit scoring models and asset-backed securities markets have transformed the production of consumer credit and home mortgages from a traditional portfolio lending process, where banks earn mostly interest income, to a transaction lending process in which banks earn mostly non-interest income, for example, loan origination fees and loan servicing fees. Advances in communications and information technologies have led to new production processes for transactions and liquidity services, such as ATMs, automated teller machines, and online bill pay. And deposit customers have been willing to pay fees for these conveniences. The phase-out of regulation Q ceilings on deposit interest rates assisted banks in this regard, allowing them to price depositor services in a more rational and competitive fashion. Similar to the non-interest income generated by non-traditional activities, the fee income derived by these new production methods is uneven across banking companies. Securitized lending processes generate significant scale economies, and as a result, fee income from securitized consumer and mortgage lending has flowed predominantly, though not completely, to large banking companies. In contrast, the scalable technologies necessary to produce ATM and internet banking services are accessible to even relatively small banks. Taking advantage of the highly detailed financial statements that commercial banks and bank holding companies provide to their regulators, we collected data for established U.S. banking companies in 1986, 1990, 1995, 2000, and 2003. This multi-year, multi-company dataset allows us to observe how business strategies differ across banking companies in a given year and how banking strategies have changed over the past 2 decades as regulatory, technological, and competitive conditions have changed. 1. For the purpose of our analysis, an established banking company is either an independent commercial bank that is at least 10 years old or a bank holding company, BHC, or financial holding company, FHC, that controls one or more commercial banks that are on average at least 10 years old. These categories of banking companies are inclusive of all mature U.S. commercial bank charters, and as such, they include banking companies of all sizes, from small, independently organized community banks to large financial holding companies, that operate using a diverse array of banking business strategies. We approach these data somewhat differently than most financial analyses of the commercial banking industry. First, we pay as much attention to bank income statements as we do to bank balance sheets. Financial analysis of commercial banks often concentrates on bank balance sheets, which display the most direct evidence of banks' traditional intermediation activities between depositors and borrowers. Deposits are the largest single item on the liability side of most banks' balance sheets, and loans are the largest single item on the asset side of most banks' balance sheets. But balance sheets have become an increasingly incomplete records of banks' profit-generating activities. They convey very little information about the fee-based activities that now generate over 40% of total operating income in the banking industry. Some of these fee-based activities are traditional, like providing services to depositors and private banking clients. Some are new to commercial banks, like investment banking, venture capital, and insurance underwriting, and some are traditional banking activities, produced using new non-traditional methods, like automated lending processes. Because income statements display the revenues and expenses generated by all of a bank's activities, whether or not they are represented on the balance sheet, we analyze bank income statements first before moving on to bank balance sheets. Second, we construct financial ratios 2 different ways. We construct composite, or size-weighted, financial ratios using aggregate data for the entire commercial banking industry, and we construct bank-level, or unweighted, financial ratios using data from individual commercial banks. The composite financial ratios are informative about the overall product mix, financing mix, risk, and profitability of the commercial banking industry. But these ratios may not be descriptive of the typical commercial bank because large banks dominate the aggregate data. To the extent that a typical bank exists, and this is a problematic concept in itself, as discussed in the companion article that follows, it would be better described by taking the average of the bank-level ratios. For some financial ratios, the size-weighted and unweighted averages have similar values, but for other ratios, these 2 approaches yield substantially different values. As we shall see, these differences can reveal important information about how commercial banks make money. Large size allows banking companies to serve large corporate clients and provides them with access to low-cost, high-volume production, distribution, and marketing processes. But large size can make it difficult for banking companies to provide personalized retail service and/or build relationships with their small business loan customers. The financial data for independent banks were drawn primarily from the reports of condition and income, call reports, and the financial data for BHCs and FHCs were drawn primarily from the Federal Reserve Board FRY9C reports. These data were augmented with data from a number of other sources, including the Federal Reserve Board National Information Center's NIC Structure Database, the Federal Deposit Insurance Corporation's Summary of Deposits database, and the Center for Research on Stock Prices, CRSP. To be included in the dataset in any given year, a banking company had to be domestically owned, have positive amounts of loans and transaction deposits, have positive book value, and be FDIC insured or own at least one commercial bank that was FDIC insured. We express all data in thousands of $2003 unless otherwise indicated. The number of banking companies has declined over time for two reasons. Nearly 1,000 commercial banks failed. During the first 10 years of our sample period, and in each year of our sample period, hundreds of banking companies were merged or acquired. These trends were mitigated to some extent by the thousands of new banking companies that were started up during the 1980s and 1990s, entering our dataset upon turning 10 years old, and by the entry of some non-bank FHCs, investment banks, insurance companies, and securities firms after 1999 under the provisions of the Gramm-Leach-Bliley Act. The size of the average banking company increased substantially during our sample period in terms of assets, operating income, book value, employees, and branches. The most systematic change in bank income statements during our sample period is the increasing incidence of non-interest income, which now accounts for about 20% of operating income at the average commercial banking company, up from about 13% in 1986, and about 47% of total industry operating income, up from about 30%. In other words, today the banking industry generates slightly more than $1 of net interest income for every $1 of non-interest income, compared with just 2 decades ago when this industry multiple was well over $2. As discussed above, the increased importance of fee income at commercial banking companies is a direct result of structural changes like industry deregulation, new information technologies, and financial innovation. The companion article that follows discusses the implications of these changes for competitive strategies at commercial banking companies. The expense data suggest that the banking industry has become more cost-efficient over the past 2 decades. Non-interest expenses currently consume about 59 cents of every $1 of operating income generated by commercial banking companies, down dramatically from about 69 cents in 1986. A large part of this decline is due to increased competitive pressure and the incentives this creates for banking companies to operate more efficiently. Shifts in the banking product mix and the introduction of new ways to produce and distribute traditional banking products likewise have contributed to this decline in expenses. Note that the number of full-time employees per dollar of operating income has fallen precipitously over time, while industry-wide labor expenses have declined only marginally and have actually increased at the average bank. These conflicting trends provide evidence that new banking products and production methods require a more highly skilled workforce, and hence higher salaries and benefits to attract and retain these workers. For example, while low-wage bank tellers have become less necessary due to ATMs and online banking, high-wage finance, and information professionals have become more necessary to manage these systems and the growing array of products offered over them. Labor expenses, premises expenses, and other non-interest expenses have all declined over time for large banks, which dominate the size-weighted ratio averages. But in contrast, only one of these 3 expense items has declined for the average bank, which is better represented by the unweighted ratio averages. As large banking companies have grown even larger via industry consolidation, they have increasingly benefited from scale economies that drive down per-unit costs. Moreover, large banking companies are more likely to participate in high-volume, fee-based activities like automated lending, online banking, and mass marketing campaigns that benefit from scale economies. Naturally, the small banks cannot benefit as much from these economies of scale, not only because of their small size, but because many small banks practice more personal, relationship-based strategies that require relatively more customer-server vice labor inputs and relatively more physical spaces to interact with their customers. Although expenses have declined less for the average banking company than for the industry overall, the proof of improved bank efficiency is in the profit pudding. Net income has increased substantially to just over 20% of operating income for both the average banking company and the industry as a whole. Because this return on sales, ROS profit measure is a relatively uncommon way to express banking profitability, we also include the more familiar ROA and RO measures, both of which have increased over time as well. This broad improvement in profitability has three fundamental causes: improved cost and revenue efficiency due to advances in information, technology, and financial processes, improved cost and revenue efficiency in response to the competitive pressures brought on by industry deregulation, and the generally improved banking environment starting in the mid-1990s, reflected in the table as reduced loan loss provisioning. The ROA and ROE data suggest that the average bank, with an ROA of 1.05% and an ROE of 11.02% in 2003, is less profitable compared with the industry-wide aggregate ROA and ROE measures of 1.35% and 16.41%, respectively. As with many of the other differences we observe in the financial data, higher levels of non-interest activities at some banks also help explain these differences in the ROA and ROE measures. Because large banking companies tend to generate large amounts of fee income from activities that are not found on the balance sheet, for example, fee income from securitized lending activities, these banks will naturally appear to be more profitable using an ROA measure. Additionally, because large banking companies tend to be more diversified across product lines and customer bases and are more likely to use derivative securities and complex modeling techniques to mitigate risk, they can operate with a smaller cushion of equity capital. Therefore, they will also appear to be more profitable using an ROE measure. Thus, for slightly different reasons, large banking companies will have higher traditional accounting performance measures than smaller banking companies, all else being equal. Note, however, that ROS, ROA, and ROE are not risk-adjusted performance measures, and thus using these measures to compare the profitability of different banks is an incomplete performance analysis. The dramatic increases in non-interest income over the past 2 decades have not occurred in isolation from other banking activities, and as such, they have left a trail not only on bank income statements, but also on bank balance sheets. The increase in non-interest income has occurred in consort with changes in virtually every other area of commercial bank activities, including interest income, interest and non-interest expenses, bank asset mix, and bank funding sources. In 1986, the average banking company had 50% of its assets invested in low-yielding assets like cash, securities, and Fed funds, and only about 47% in loans. But by 2003, investments in loans at the average banking company were nearly twice as large as investments in lower-yielding assets, 61.1% versus 34.9%. Low-yielding cash balances have also declined for the industry as a whole, size-weighted ratio averages, but investments in loans have also fallen substantially, from 62.3% to 52.5% of assets. However, this does not necessarily indicate a reduction in investment efficiency. These data are consistent with a shift in the production functions of large banking companies away from traditional portfolio lending, and its reliance on interest income and toward securitizable transaction lending, especially credit cards and home mortgages, that relies on non-interest income from loan origination and loan servicing fees. The 10 percentage point reduction in loan assets has been more than offset by a 12 percentage point increase in other assets, such as the fair value of derivatives instruments, used to hedge against interest rate and foreign currency risk and receivables on the interest rate portion of asset-backed securities, IO strips. Real estate loans have become a much more important part of bank loan portfolios over the past 2 decades. A number of factors played a role in this, including easier access to mortgage financing, the 1986 Tax Reform Act that eliminated the consumer debt interest deduction but maintained the mortgage interest deduction, an increase in home ownership rates, the run-up in single-family home prices in many markets, as well as a need for banking companies to replace lost market share in commercial and industrial C&I loans. Between 1986 and 2003, C&I loans declined from 31.53% to just 18.90% of the overall industry loan portfolio, as large business borrowers began to bypass banks in favor of direct finance, for example, issuing commercial paper or high-yield debt. and non-bank competitors such as insurance companies and investment banks began to compete with banks for the remainder of the shrinking C&I loan market. Deposits are the single most important source of financing for banking companies. Community banks use higher levels of deposit funding, and their non-interest income streams depend heavily on depositor service charges. However, even these high levels of deposit funding mark a decline over the past 2 decades in favor of increased funding from federal funds, subordinated debt, other liabilities, and equity financing. This reflects at least 3 developments: increased competition from non-banks, for example, mutual funds, brokerage accounts, for household and business deposits, the expanded ability of large banking companies to raise debt in financial markets, for example, commercial paper, subordinated debt, and regulations that now require banks to hold higher levels of equity capital than in the past. The composition of deposits has also changed over time, and these trends reflect differences in the ways that large and small banks do business. For the typical banking company, transaction deposits have held relatively steady over the years, at about 28% of total deposits in general and about 15% of total deposits for banks' business clients, demand deposits. Thus, relationships with depositors and access to the payment system continue to be essential parts of most banking companies' business strategies. In contrast, transaction deposits have declined dramatically at the industry level, from 29.8% to 15.0% of total deposits since 1986. Both traditional and non-traditional banking activities generate non-interest income. Traditional fee-generating activities include transaction services for retail and business depositors, although in recent years a growing percentage of these fees has been charged for non-traditional technologies like online bill pay, and fiduciary services for high-net-worth retail clients. Non-traditional fee-generating activities include investment banking, insurance underwriting and agency, and venture capital. Finally, banking firms generate a substantial amount of non-interest income by using non-traditional methods to produce traditional banking services. For example, in a traditional banking model, loan servicing fees and securitization fees do not exist because banks hold the loans they originate in their own portfolios and service these loans themselves. The composition of non-interest income also differs across banking companies of different sizes. Large banking companies generate disproportionately more non-interest income from securitizing and servicing mortgage and credit card loans because the automated production processes used to produce these services exhibit substantial scale economies. Similarly, large banking companies are better able to employ the concentrations of financial experts and develop the institutional information databases necessary for the production of investment banking, insurance underwriting, and private banking, fiduciary services. However, there are other areas in which smaller banking companies generate a higher percentage of non-interest income than larger banking companies. Because small banking companies rely more on core deposit funding, such as household and small business checking accounts, than do larger banks, deposit service charges comprise a large part of their fee income base. And fee income from the sale of insurance products shows no size bias, possibly because small banking companies have been successful at cross-selling insurance products to their existing household and small business clients. As discussed above, increased competition from non-banks and out-of-state banks in the years following deregulation put downward pressure on the profitability of commercial banking companies. Banks were sensitive to these coming challenges long before deregulation was fully implemented. For example, in a 1983 study, the Texas Bankers Association concluded that if the banking industry was to remain profitable in a deregulated environment, it must fundamentally change the way in which it makes money. The study found that in order to offset expected declines in net interest margins due to post-deregulation competition, fee income would have to increase from about 15% of total income to over 50% of total income by 1986. Lane, Friars, and Goldberg, 1983. As we have seen above, many banking companies heeded the spirit of this advice by offering an expanded menu of fee-based products and services. The financial consequences of these strategic shifts toward fee income were not well understood at the time. The upward trend in non-interest income during the 1990s was generally believed to have two risk-reducing effects. Shifting banks' income mix away from intermediation-based activities would reduce banks' exposure to credit risk and interest rate risk. And shifting banks' income mix toward fee-based financial products and services would reduce earnings volatility via diversification effects. As late as 2000, many bankers continued to believe that fee income would be a stable income stream. Indeed, shareholders and analysts alike have grown fond of the earnings, diversity, growth potential, and market insulation that fees provide. Engen, 2000. To some extent, industry-wide trends in income mix and profitability offered superficial support. For this view, between 1980 and 2003, non-interest income doubled as a percent of total industry operating income at U.S. commercial banking companies, while at the same time, aggregate industry profitability, ROE, not only increased but became more stable. But such an analysis is indeed superficial, and it ignores growing evidence to the contrary. Recent empirical studies indicate that although an increase in non-interest income may improve bank earnings, this seldom occurs without concomitant changes in interest income, variable inputs, fixed inputs, financing structure, and other changes that have risky implications for the variability of bank earnings. DeYoung and Rowland, 2001, suggest three reasons that non-interest income may increase the volatility of bank earnings. First, loans that are held in a bank's portfolio, especially loans to businesses, are relationship-based. That is, banks have close ties to their borrowers that allow them to ascertain borrower creditworthiness by building up a storehouse of private information about the borrower and monitoring the activities of the borrower going forward. Because these informational ties are costly for both the bank and the borrower to replicate, relationship-based loans often have high switching costs. In contrast, some fee-based activities are not relationship-based and hence have low switching costs, such as fees from originating a mortgage or from non-customers using a bank's ATM machines. Thus, despite exposing the bank to credit risk and fluctuations in interest rates, interest income from loans may be less volatile than non-interest income from many fee-based activities. Second, a bank that shifts its product mix from traditional asset-based, interest-generating activities to non-traditional fee-based activities tends to increase its degree of operating leverage. For example, within the context of an ongoing lending relationship, the main input needed to produce more loans is a variable input, that is, interest expense. In contrast, the main input needed to produce more fee-based products is typically a fixed or quasi-fixed input, that is, labor expense. Thus, fee-based activities may require greater operating leverage than lending activities, which makes bank earnings more vulnerable to declines in revenues. Third, most fee-based activities require banks to hold little or no fixed assets. So, unlike interest-based activities like portfolio lending, fee-based activities like trust services, mutual fund sales, and cash management require little or no regulatory capital. This allows banks to finance a greater amount of their income generating activities with debt, which increases fixed interest expenses. In other words, fee-based activities allow banks to use a greater degree of financial leverage than lending activities. Banks with low fixed costs and high variable, that is, a low degree of total leverage, are represented in Panel A by the solid line, labeled Bank 2. Banks with high fixed costs and low variable costs, that is, a high degree of total leverage, are represented by the dashed line, Bank 1. Theoretically, banks with large amounts of fee-based income will have a high degree of total leverage like Bank 1, so that any given change in revenue along the horizontal axis gets amplified into a greater change in earnings along the vertical axis. For example, when sales equals amount A, both Bank 1 and Bank 2 are earning about 5 units of profit. If sales revenue for both firms increases to B, Bank Y will realize a much greater change in profits, from 5 units to 25 units, while the earnings for Bank 2 will increase from 5 units to about 15 units. To make matters worse, the distribution of sales revenues can also vary across banks. The flatter of the two distributions represents sales that are more volatile, while the more bell-shaped of the two represents sales that are less volatile, that is, they will not vary as much around the mean. Theoretically, revenues derived from non-relationship-based fee-generating activities with low switching costs, that is, home mortgage origination, or high sensitivity to the business cycle, that is, investment banking, can be more volatile than revenues from traditional relationship-based banking lines of business. A bank with more of these types of activities would be likely to have sales revenues represented by the flatter of the two distributions. This would be more likely to change from quarter to quarter, all else being equal. Using data from U.S. banks during the 1990s, DeYoung and Rowland, 2001, find evidence consistent with these theoretical conjectures. They demonstrated that income from fee-based activities was more volatile than income related to traditional intermediation activities, that is, interest from loans, interest from securities, and service charges from deposits, and that the degree of total leverage tends to be greater at banks that generate large amounts of fee income from non-traditional activities. They find also that the type of fee-based activity in which the bank engages makes a difference. Increased reliance on trading activities increases the volatility of overall bank revenues, while increased reliance on charging fees to depositors reduces the volatility of overall bank revenues. Studies that followed generated similar findings. Stiro, 2004a, finds that an increased focus on non-interest income is associated with declines in risk-adjusted performance. In another study, Stiro, 2004b, finds potential diversification benefits for banks that offer a variety of different fee-based services, but no diversification benefits for banks that produce a combination of interest-based and fee-based services. In DeYoung and Rice, 2004, we find that increases in non-interest income are associated with higher but more volatile accounting rates of return, resulting in reduced risk-adjusted returns. We also find that an increase in non-interest income does not necessarily indicate that intermediation activities have become less important at banking companies. If intermediation activities have become less important for banks over time, we argue in DeYoung and Rice, 2004, then it stands to reason that the correlation between bank profitability and bank net interest margin would grow weaker over time. But to the contrary, we show that the correlation of bank earnings, ROE and ROA, and net interest margin has not grown weaker over time and may have actually strengthened slightly. Finally, we find that well-managed banks tend to focus on a narrow set of fee-based activities, most of which are unrelated to either traditional core deposit business or trading activities. This includes, among other items, fees from the sale of mutual funds and insurance policies, fees from securitization activities, income from loan servicing, fees from providing trust services, and income from providing cash management services. In DeYoung and Rice, 2004, we conclude that increased non-interest income is coexisting with, rather than replacing, intermediation activities at the typical commercial bank, and that traditional intermediation activities remain the core activity of most profitable banks. Providing payment services is an underappreciated source of non-interest income for banking companies, and its importance may be growing. Payment-related information technology at banks was expected to grow about 37% between 2003 and 2004. Access Intelligence, LLC, 2004. Wachovia Corp. reorganized its payment operations to create a centralized payment division, Wade, 2003, while Bank of America Corp. overhauled its internet banking and bill pay website, Bills, 2003. As the menu of payment products and services available to consumers increases, bankers have recently acknowledged that only within the last 2 to 3 years has there been a realization of the importance of payments, Wade, 2003. Since customers generally use transaction accounts to make and receive payments, banking companies play a natural role in the payment system. And although competition from non-banks using new payment technologies has increased, it is likely that banks will remain primary providers of payment products and services, because banks have two unique features with regard to the payment system that non-bank firms do not share. First, financial institutions have the ability to offer settlement activities. Settlement here is defined as the irrevocable transfer of funds between parties in a payment system. While non-bank firms are very much involved in the processing of payments in the U.S. economy, only financial institutions can settle payment transactions, because all non-cash payment transactions, except for on-US transactions, require the transfer of funds between two financial institutions. For example, Fiserv is a large vendor or third-party provider of transaction services, such as customer account processing and check processing and imaging. But it does not settle checks with customers' accounts. Only banks can settle their customers' accounts. Second, because the payment system is heavily reliant upon deposit-based instruments, banks are in a unique position to profit by cross-selling payment-based, payment-related, and non-payment-related products and services to their deposit customers. For example, banks offer customers a broad menu of payment methods with which to access the funds in their deposit accounts, such as checks, debit cards, direct debit for paying bills, direct deposit for receiving paychecks, and online bill paying. Depending on their business model and competitive strategy, banks can and do charge fees for these payment-related services. Chakravorty and Kobor, 2003, suggest that banking companies use two different approaches for using payment activities to enhance their profits: a standalone product approach and a product bundling approach. Standalone payment strategies are highly specialized. Some examples include securities processing and handling, management of large personal and corporate trust accounts, and correspondent banking services. These lines of business tend to generate revenue streams that are independent from banks' other activities and tend to use specialized and often large-scale production processes as well. In contrast, banks that use a product bundling strategy will market and price their payment products in conjunction with other retail or wholesale products. Retail products would include, for example, services tied to personal deposit accounts, while wholesale products would include corporate transactions. Although payment products may not contribute directly to profits in this approach, including them in a bundle of related services can increase the retention of deposit customers. In contrast to fee-based activities that are not relationship-based, such as home mortgage origination, as discussed above, products and services linked to deposit accounts can be sticky, that is, they make it less convenient for deposit customers to transfer their funds to another institution. For example, deposit customers that use direct deposit and automatic bill payments are less likely to switch to another institution because they will have to incur the costs, time and effort, of undoing these automated arrangements at their current bank and setting them up again at their new bank. Banking companies have become increasingly aware that their profits can be enhanced by offering costly new relationship-based services, such as expanded networks of branches or ATMs, at low prices or for a fee, where payment is in the form of foregone interest, because the switching costs associated with these services can embed the customer more firmly in the long run. First, Lang and Knoll, 1998, Kaiser, 2002, DeYoung and Hunter, 2003. Given that banks use payments for vastly different strategic reasons, it is difficult to model and measure how payments contribute to profits. Two recent Federal Reserve studies have grappled with this problem. Radecki, 1999, estimated that the top 25 U.S. banking companies derived between 1/3 and 2/5 of their operating revenue, non-interest income plus net interest income minus provisions for loan losses, from payment-related activities in 1996. This innovative study was the first to estimate the proportion of income at banks that is attributable to payment activities, and it made two essential contributions to our knowledge of the role of payment services in banking strategy. First, by expanding the definition of payment activities to include transaction services performed outside a deposit account relationship, Radecki revealed the surprising depth of payment activities at large banking companies. Second, his study reminds us that payment services are integral to the strategic and financial functioning of most banking companies because they are intertwined with the production of deposit or taking and information-intensive lending activities. Rice and Stanton, 2003, updated and expanded Radecki's study by estimating the volume of payment-driven revenues at the top 40 bank holding companies in 2001. In order to obtain a larger sample of banking companies, Rice and Stanton drew their data from the financial reports, Call Report and Y9, that U.S. banking companies file with their regulators rather than relying on banking company annual reports, which do not offer consistent information on payment-driven revenues in several important categories. In addition, these authors adjusted some of Radecki's approximation methods, which may have overallocated some bank revenues to payment activities. They conclude that payment revenue accounts for 16% to 19% of operating revenue, a substantially lower estimate than Radecki's, but still a surprisingly large contribution to the overall revenue streams of banking companies. To estimate the contribution of payment activities to the income of the 2,662 banking companies. In our sample in 2003, we apply the estimation employed by Rice and Stanton using the Call and Y9 reports. Most of these data are not available prior to 2001. The method identifies 4 separate sources of payment-driven revenues. Traditional service charges on deposit accounts are composed of 2 parts: the explicit fees charged to depositors and the foregone interest revenue implicitly charged to depositors. It is easy to overlook the fact that depositors compensate banking companies for the convenience of having transaction accounts by foregoing interest on their account balances. Customers earn no interest on demand deposit account, DDAs, and earn below-market rates on deposits in negotiable order of withdrawal, NOW, savings, and money market accounts, MMDAs. These low-cost funds are key to banking companies' traditional intermediation activities, in which they earn profits by reinvesting these funds in higher-yielding and higher-risk market-rate loans and investments. Foregone interest revenue is relatively straightforward to estimate. For our calculations, we assume that deposits in all accounts earn the banking company the federal funds rate, that is, the bank's alternative funding rate. For each type of deposit account, we take the average spread between the federal funds rate and the deposit rate and multiply it by the aggregate balance in each type of deposit account. We then sum up the interest foregone by depositors by account type, DDAs, NOW and other interest checking accounts, and MMDA and other savings accounts. These explicit, service charges, and implicit, foregone interest charges on deposit accounts make up the lion's share of payment-driven revenue at the typical banking company. Radecki, 1999, contains an in-depth discussion on estimating foregone interest payments from banking companies. Trust and investment services, income. Some portion of banks' income from fiduciary, trust activities is payment-related. As such, this should be included in the aggregate estimates of payment-driven revenues. Estimating the amount of payment-related trust revenues, however, is extremely difficult. Depending on the type of trust account that is managed or held by a BHC's trust department, the BHC will earn a wide range of revenues from payment activities. At one end of the spectrum are trust accounts, where no cash will be distributed nor payments made to the customer in the foreseeable future. A personal trust containing non-dividend paying market securities is a good example. The main fees charged to that trust by the BHC are portfolio management fees, not payment activity fees. At the other end of the spectrum are trusts that pay out monthly distributions of income to the beneficiary of a trust account. That does not require much, if any, portfolio management. The majority of the activity in this type of account is payment-related, so the majority of revenue earned by the BHC can be attributed to payment activities. Because the available data do not allow us to observe these differences in the intensity of fee income in the trust accounts of different banking companies, we create both a high estimate and a low estimate of these revenues for each bank. At the low end of the spectrum, we only include revenues generated from custody and safekeeping accounts, since most of the revenue earned in these accounts is derived directly from payment-related activities. We acknowledge that this excludes payment-related activities in other types of accounts, such as retirement and corporate accounts. However, some of these revenues are captured above as service charges and foregone interest revenues associated with deposit accounts. At the high end of the spectrum, we add in revenues from employee benefit accounts and corporate trust and agency accounts. This may overstate payment-related revenues because the revenues recorded in these additional categories include fees from some non-payment-related activities. Payment-related credit card fees are also difficult to measure. Fee income from credit cards includes late payments, interest on credit card balances above the cost of a traditional loan, finance charges for cash advances, fees for handling transactions on behalf of merchants and cardholders, and interchange fees for credit card purchases. Not all of these fees can be considered payment-related, however, and the situation is complicated further by the securitization of credit card assets, which moves a considerable amount of this activity off of the main balance sheet of the banking company. The banking company continues to earn a portion of the revenue from securitized credit card receivables through the excess collateral from annual fees and other payment-related service charges, and so we must account for revenue generated by those assets as well. Following Rice and Stanton, 2003, we estimate the payment-related revenue from both the on-balance sheet and off-balance sheet credit card receivables. Based on data from Visa and MasterCard, Credit Card Management 2001, Rice and Stanton estimate that about 17% of all credit card revenues are derived from payment services. Hence, we estimate both on-balance sheet and off-balance sheet payment-related credit card revenue by multiplying total revenue associated with credit cards by 0.17. Beginning in 2001, the Call and Y9 reports require that all banks report the income and fees from automated teller machines, ATMs, in the category of other non-interest income when it exceeds 1% of gross interest income plus non-interest income. As a result, some banking companies show ATM revenues of zero or missing, when in fact they are just below the 1% threshold. This will obviously result in an understatement of ATM revenues in our estimates. The importance and the mix of payment-related fees vary considerably by banking company size. For small banks, payment-related income is twice as large as non-payment-related fee. Income, 21.12% versus 10.45%, while these figures are reversed for large banking companies, 17.96% versus 38.55%. The average small banking company earns 97% of its payment-related revenue through traditional deposit accounts, deposit fees plus foregone interest, compared with only about 65% for the average large banking company. The typical large bank earns the balance of its payment-related revenue primarily through fiduciary income on trust accounts, about 23%, and credit card fees, about 10%. Some large banking companies specialize in payment activities. State Street Corporation, for example, is the largest servicer of mutual funds and pension plans in the U.S., with more than $9 trillion in assets under custody. It earns an estimated 36% of its operating revenue from fiduciary fees on those custodial accounts. Other large banking companies emphasize payment activities from more traditional sources, for example, as mentioned above, Bank of America reorganized its online bill payment webpage, eliminated its monthly fee, and saw its usage more than double between 2002 and 2003. As a result, the bank achieved both higher deposits and the higher retention benefits. Bills 2003. Clearly, banking companies do more than just intermediate between depositors and borrowers. The industry has never limited itself to simply earning interest margins, and over time it has moved further away from that stylized version of how banks make money. The most telling symptom of this movement is the remarkable increase in non-interest income at commercial banks, which by some measures now accounts for nearly half of the industry's income. For some banks, increases in non-interest income flow from new lines of business, such as investment banking, securities brokerage, and insurance agency, that were made possible by a historic dismantling of restrictive financial regulations in the 1990s. For other banks, increases in non-interest income flow from producing traditional banking services, such as securitized lending and electronic payment services, with new production processes that were made possible by advances in information technology, communications channels, and financial processes. Many banks have done both. These changes have some surprising implications for the performance of financial institutions. Conventional industry wisdom held that rebalancing bank income away from interest income and toward non-interest activities and fee income would make banking companies less risky. Replacing interest income with its sensitivity to unpredictable movements in interest rates and the business cycle would reduce the volatility of bank income. And expanding into non-traditional fee-based activities would yield risk-reducing benefits of diversification. However, recent research suggests that, at least so far, this has not come to pass. Diversification gains from fee-based activities appear to be scarce, and Although there is some evidence that fee income can pump up bank earnings, this also tends to make bank earnings more, not less, volatile. Perhaps just as surprising is the realization that traditional banking activities, namely the provision of payment services, generate the lion's share of non-interest income at most banking companies. We extend the work of Radecki, 1999, and Rice and Stanton, 2003, and find that for the average banking company with assets less than $1 billion, payment-related revenues account for about 20% of total operating income and about two-thirds of total non-interest income. Of course, the concept of the average banking company has become less meaningful over time because technological change and industry deregulation have permitted, and the resulting increase in competition has encouraged, banking companies to experiment with innovative products, production processes, organizational forms, and business strategies. We explore implications of these developments in the companion article that follows, which compares the financial performance of banking companies across different business strategies, from community banking to private banking to corporate banking and beyond. In conclusion, banks are financial institutions that play a crucial role in the economy by facilitating the flow of money and providing a range of services to individuals, businesses, and governments. At their core, banks operate on the principle of financial intermediation, which involves accepting deposits from customers and lending those funds to borrowers. This process supports economic activities by providing a safe place for people to save money and a reliable source of credit for those needing funds. Banks offer various types of accounts, such as savings, checking, and time deposits, where customers can store their money securely. These accounts often come with different interest rates and conditions, providing options for both short-term liquidity and long-term savings. Deposits are the primary source of funds for banks, and they typically pay interest to depositors. Although the rates vary depending on the type of account and the prevailing economic conditions. The funds collected from deposits are used to provide loans to individuals and businesses. These loans can be for various purposes, including buying homes, mortgages, financing businesses, business loans, or covering personal expenses, personal loans. Banks charge interest on the loans they provide, which serves as a primary source of revenue. The difference between the interest rates paid on deposits and the rates charged on loans is known as the interest rate spread or net interest margin. Banks facilitate a wide range of payment services, including electronic transfers, credit and debit card transactions, and checks. These services allow individuals and businesses to transfer money and make payments efficiently. Banks also operate clearing systems that settle payments between different banks, ensuring the smooth functioning of the payment infrastructure. Many banks offer investment products and services, such as wealth management, brokerage, and advisory services. These services help clients invest their money in various financial instruments, including stocks, bonds, and mutual funds. Banks may also engage in trading and investment activities on their own account, although these activities are often regulated to prevent excessive risk-taking. Banks are involved in various risk management activities, including the assessment and mitigation of credit risk, the risk that borrowers will default on their loans, market risk, the risk of losses due to changes in market conditions, and operational risk, the risk of loss due to failures in internal processes or systems. They use various tools, such as credit scoring, collateral requirements, and derivatives, to manage these risks. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, play a critical role in overseeing the banking system. They regulate the money supply, set interest rates, and provide financial stability. Central banks also serve as lenders of last resort to ensure liquidity in the banking system, especially during financial crises. Banks are subject to extensive regulation to ensure their stability and protect customers. Regulatory bodies impose capital requirements, conduct regular audits, and enforce rules on how banks can operate. These regulations are designed to prevent excessive risk-taking and protect the financial system from potential crises. Banks are vital institutions in the economy that facilitate saving, lending, and payment services. They help allocate resources efficiently, support economic growth, and provide financial stability. Through a combination of deposit-taking, lending, investment, and risk management activities, banks play an essential role in the financial system and the broader economy. Trust is the cornerstone of the banking industry. Without it, the entire financial system would struggle to function effectively. The question of whether we can trust banks is multifaceted, encompassing issues related to financial stability, ethical behavior, transparency, regulatory compliance, and technological security. This article explores these dimensions to provide a comprehensive understanding of the trustworthiness of banks. Banks are integral to modern economies, providing essential services such as safekeeping deposits, extending credit, facilitating transactions, and offering investment products. They play a crucial role in economic growth by lending money to businesses and individuals, thereby fueling entrepreneurship, consumer spending, and infrastructural development. Additionally, banks are pivotal in maintaining the flow of money in the economy, enabling efficient capital allocation and liquidity management. One of the primary factors contributing to trust in banks is the extensive regulatory framework governing their operations. In most countries, banks are subject to stringent regulations designed to ensure their solvency, protect depositors, and maintain the integrity of the financial system. Regulatory bodies, such as the Federal Reserve in the United States, the European Central Bank in the Eurozone, and the Financial Conduct Authority in the UK, enforce these regulations. These institutions require banks to maintain certain capital reserves, conduct regular audits, and adhere to specific operational standards. They also have the authority to step in during financial crises to prevent bank failures and systemic collapses. This regulatory oversight is crucial for maintaining public confidence, as it assures customers that their money is secure and that banks are operating in a safe and sound manner. While regulations provide a safety net, the ethical conduct of banks is another critical component of trust. Banks must operate with integrity, fairness, and transparency to maintain the confidence of their customers and the public. However, the history of banking is marred with instances of unethical behavior, from the financial scandals of the early 2000s to the more recent controversies like the Wells Fargo fake account scandal. Such incidents can significantly damage the reputation of banks and erode public trust. To counteract this, many banks have implemented comprehensive corporate governance frameworks and ethical guidelines. These measures aim to promote responsible banking practices, prevent conflicts of interest, and ensure that banks act in the best interest of their customers. Moreover, the rise of corporate social responsibility, CSR, has seen banks increasingly involved in community development, environmental sustainability, and other socially beneficial initiatives. These efforts are designed to rebuild and maintain public trust by demonstrating a commitment to ethical conduct and societal well-being. Transparency is another critical aspect of trust in banking. Customers need clear, accurate information about the products and services they are using, including the associated risks, fees, and terms. Banks that prioritize transparency tend to be more trusted because they allow customers to make informed decisions. However, transparency is not just about providing information, it's also about effective communication. Banks must communicate proactively with their customers, especially in times of crisis or when changes occur. For example, during the 2008 financial crisis, a lack of transparency and poor communication from some financial institutions exacerbated public fears and mistrust. Conversely, banks that communicated openly and honestly were better able to maintain customer confidence. The digital transformation of banking has introduced both opportunities and challenges concerning trust. On the one hand, technology has made banking more convenient, accessible, and efficient. Online banking, mobile apps, and digital payment systems have revolutionized how people interact with their financial institutions. However, the rise of digital banking also raises significant concerns about data security and privacy. Cybersecurity threats, such as hacking and identity theft, can severely undermine trust in banks. A single data breach can compromise sensitive personal information, leading to financial loss and emotional distress for customers. To address these risks, banks invest heavily in cybersecurity measures, including encryption, multi-factor authentication, and real-time fraud detection systems. They also comply with data protection regulations, such as the General Data Protection Regulation, GDPR, in the European Union, which sets strict standards for how customer data should be handled and protected. Despite these measures, incidents of data breaches and cyber attacks still occur, reminding us that no system is entirely foolproof. Nevertheless, banks' efforts to protect customer information and their transparency about handling security incidents are crucial for maintaining trust. While banks are responsible for maintaining a trustworthy environment, customers also play a role in safeguarding their own interests. It's essential for customers to be vigilant, informed, and proactive. This includes understanding the terms and conditions of financial products, monitoring accounts regularly for unusual activity, and being cautious with sharing personal information. Customers should also choose their banks carefully, considering factors such as the institution's reputation, financial health, and customer service quality. Trust in banks is a complex issue influenced by a myriad of factors, including regulatory frameworks, ethical conduct, transparency, technological security, and customer vigilance. While most banks operate under strict regulations and strive to uphold ethical standards, there are occasional lapses that can undermine public confidence. However, the robust regulatory environment, coupled with banks' increasing focus on transparency and security, generally supports a foundation of trust. Ultimately, while there is no guarantee that every bank will always act in the best interest of its customers, the extensive safeguards and oversight mechanisms in place provide a strong basis for trust. As the banking landscape continues to evolve, particularly with the ongoing digital transformation, maintaining and building this trust will require continuous effort from both banks and customers alike.